The Social Security Administration has already paid out $17 billion in retroactive checks to 3.1 million Americans, and most retirees have no idea whether their name is on that list or not. If you are a retiree or close to retirement age, four silent forces are quietly eroding your monthly benefit right now, and the system is not going to flag any of them for you. Quick note before we dig in. This is general education, not advice for your specific situation, so please use what you learn here as a starting point. By the end of this video, you will know exactly which of those four forces is hitting your check, what to do about each one this week, and which one of them might mean a check with your name on it sitting at Social Security right now. Let me start with the one that affects every single retiree in America. The 2026 cost of living adjustment is 2.8%, announced by the Social Security Administration on October 24th of 2025. For the average retiree, that adds about $56 a month to your check. So far, that sounds fine. Now picture this, the same month that 2.8% raise hits your bank account. The standard Medicare Part B premium climbs to $202.90. That is up $17.90 from last year, or about $214.80 over the course of the year. So your $56 raise is real, but $17.90 of it walks straight back out the door before you can spend it. That is not the system being dishonest with you. That is just math nobody puts on the same page. Now you might be thinking, well, the cost of living adjustment is supposed to track inflation, so what is the problem? Here's the part most retirees never hear. The adjustment is calculated using the Consumer Price Index for urban wage earners and clerical workers, called CPI-W, based on the third quarter of one year compared to the third quarter of the next. CPI-W tracks the spending of urban wage earners. It does not specifically track what retirees spend money on. And retirees spend a much bigger share of their income on healthcare and housing, two categories that often rise faster than the general index. So the headline number is the index doing its job. The felt experience of your dollar shrinking is also real. Both of these things are true. For the average retiree in 2025, after the Medicare Part B increase came out, the net gain on the cost of living raise was around $40 a month, not the full $50. That is the gap your grocery bill has been telling you about. You were not imagining it. And here's the part nobody mentions. The 2.5% adjustment for last year started with January payments, not May. There was no surprise May 1st change to your check. The erosion is not a one-time event. It is happening every single month, quietly in the background, while everyone waits for some big announcement that never comes. That is force number one. Now let me show you something far bigger that may already have your name on it. If you or your spouse ever worked as a teacher, a firefighter, a police officer, or a federal employee hired before 1984, the next 2 minutes might be the most important part of this video for you. On January 5th of 2025, the Social Security Fairness Act was signed into law. That law eliminated two provisions that had been cutting Social Security benefits for public servants for decades. The first was the windfall elimination provision, which had reduced the worker's own Social Security check. The second was the government pension offset, which had cut spousal and survivor benefits, sometimes down to zero, for retirees who also received a public pension. Both are gone, permanently, effective for benefits payable from January 2024 onward. By July of 2025, the Social Security Administration had processed more than 3.1 million retroactive payments, totaling a massive $17 billion in payments. That is not a future promise. That is money already in people's bank accounts. Picture this. A retired school teacher in Ohio who spent 30 years in the classroom watched her spousal benefit get slashed for years because of the old government pension offset. As of last year, the law that did that no longer exists. She is owed retroactive money going back to January 2024. The question for you is simple. Are you, or someone you love, in that exact same situation right now, and just have not made the call yet? Now you might be thinking, was the old rule actually unfair, or did it serve a purpose? Honestly, it is a fair question. The original argument for the windfall elimination provision was to prevent what some called a windfall, where workers with pensions from non-Social Security covered jobs ended up with a higher overall benefit than someone who paid into Social Security their whole career. People debated that fairness in both directions for 40 years. As of January 2025, Congress resolved it by repealing both provisions entirely. The debate is over. The checks are going out. Here's the edge case nobody talks about. Not every public sector worker was affected by these provisions. Roughly 72% of state and local public employees worked in jobs that were already covered by Social Security, so they will not see any benefit change from this repeal. So if your old job had Social Security taken out of every paycheck like a normal job, this part probably does not apply to you. The provisions only hit workers in non-covered public employment. and the increases vary. Some retirees might see their monthly benefit jump by a few $100s. Some might see less, a few might see a great deal more. The exact amount depends on how much your benefit was originally reduced and how long. There is also a wrinkle: if you never actually filed for spousal or survivor benefits, because you were told the offset would zero them out anyway, you may need to file an application now to claim what is owed. The retroactivity is not automatic for everyone in every case. That is force number 2, and it is the one most likely to have a check sitting with your name on it at this moment. Now here's the third force, and this one might be the easiest to fix with a single form. It is called IRMAA, which stands for the Income-Related Monthly Adjustment Amount. It is a surcharge on top of your standard Medicare premium if your income from 2 years ago was above certain thresholds. Your 2026 premium is being calculated from your 2024 tax return, following a standard 2-year look-back rule. For 2025, the initial IRMAA threshold for an individual was $106,000, and for a married couple filing jointly, it was $212,000. So you might be thinking, well, that does not affect me, my income is not that high. Stay with me, because here is where it catches people. At the very top bracket, with income at $500,000 or more for an individual in 2026, the total monthly Medicare Part B premium climbs to $689.90. That is $8,278.80 per year, just for Part B, for one person. Picture this: a married couple sells a rental property in 2024 for a one-time gain. They do not earn that level of income normally, but for that one tax year, the sale pushes their reported income way up. 2 years later, in 2026, they retire. Their actual income now is modest. But the Medicare bill that arrives is calculated from that 2024 spike, not from the modest income they live on today. They are paying a surcharge on a financial life they no longer have. Here is what almost nobody talks about. There is a form for that. Form SSA-44. That form is the official Social Security Administration tool to request an IRMAA reduction, based on a qualifying life-changing event. Qualifying events include retirement, work stoppage or reduction, marriage, divorce, death of a spouse, loss of pension income, or loss of income-producing property. The form exists, the appeal is real. And Medicare actually sends out notices about these adjustments each December, so the information is out there. The trouble is that most retirees do not know to look for the form, do not know what counts as a qualifying event, and never act on it. Your situation will differ here, and the rules around what qualifies are specific. So before you submit anything, this is a good moment to talk with a financial planner or a tax professional who can look at your numbers. Some of you are still working while collecting Social Security, and force number 4 catches you off guard if you do not see it coming. In 2026, if you are under full retirement age for the entire year, the earnings limit is $24,480. For every $2 you earn above that limit, the Social Security Administration withholds $1 of your benefit. So if you earn $10,000 over the limit, that is $5,000 of benefits the agency holds back. The check just shrinks, sometimes drastically, and it surprises people who did not realize the limit applied to them. Here's the part that softens the blow. Once you reach full retirement age, the earnings limit disappears completely. You can earn any amount with no benefit reduction at all. And the months that were withheld before, the agency does eventually credit you back, in a sense, by recalculating your monthly benefit upward once you hit full retirement age. Now you might be thinking, oh great, so I get my money back later. Be careful with that framing. The recalculation is not a refund of the exact dollars that were held back. It is an adjustment to the formula that essentially treats you as if you had claimed at a slightly later age. The monthly benefit goes up. Over a long retirement, that adds up to real money. But if you needed those dollars in your 60s for living expenses, the adjustment in your 70s does not undo the cash flow gap. The edge case here is the year you actually reach full retirement age. The rules in that specific calendar year are different from both the under FRA year and the after FRA year. If that is you in 2026, run your numbers carefully or talk to someone because the calculation has its own quirks. There is one more force I have to cover because of all of these. This one quietly grows every single year without anyone in Congress voting on it. It is the taxation of your Social Security benefit itself. Here is how it works. The IRS uses something called combined income, which is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefit. If your combined income for an individual is between $25,000 and $34,000, up to 50% of your benefit can be taxable. For a married couple filing jointly, those thresholds are $32,000 and $44,000. Above $34,000 individual or $44,000 married, up to 85% of your benefit can be taxable. Now here is the part that should make you pay attention. Those thresholds were set in 1984 and 1993. They have never been adjusted for inflation, not once. Think about what that means in practice. Every year, the cost of living adjustment raises your benefit a little. Every year, those tax thresholds stay frozen exactly where they were set decades ago. So every single year, automatically, more retirees cross those frozen lines and find more of their benefit becoming taxable. The tax rates have not changed. The law has not changed. But your taxable share of benefits creeps up just because the thresholds never moved. You might be thinking, this feels wrong, like I am being taxed on something the government is paying me. The counterargument is that the revenue from taxing benefits actually flows back into the Social Security and Medicare trust funds. The system is designed to be progressive, where lower-income retirees pay little or no tax on benefits, and higher-income retirees pay more. So the existence of the tax is not a scandal. The frozen thresholds are the problem. There is also a newer tax break for individuals 65 and older that may help offset some of this in 2026. But the details depend heavily on your situation, so please run your specific numbers with a CPA before you assume anything. So now you know what is happening. Let me give you exactly what to do this week. Not next month, not eventually, this week. Step 1. Go to ssa.gov and log into your My Social Security account. If you do not have one, you can create one there. Look at your earnings history. Your benefit is calculated from your highest 35 years of earnings. So any error in your record, any year reported with a wrong number or missed entirely, directly reduces your check for the rest of your life. Verify the record, report any discrepancy. Step 2. If you or your spouse worked in a non-Social Security covered public sector job, call the Social Security Administration at 1-800-772-1213. Ask whether you are owed retroactive payments under the Social Security Fairness Act. That single phone call could be the most valuable 5 minutes you spend all year. Step 3. If you suspect you are paying an IRMAA surcharge and your income has dropped because of a qualifying life event, download Form SSA-44 from ssa.gov and file the appeal. The form exists for exactly this purpose. Step 4. If you are working while collecting benefits and you are under full retirement age, project your 2026 earnings against the $24,480 limit and decide before December how to handle it. Now, I have to be honest with you about one thing. Reaching the agency by phone can be hard right now. By late 2025, the Social Security Administration had lost between 6,500 and 7,000 employees over the prior year, bringing staffing to a 59-year low. To put that in perspective, in 2010, the agency had about 67,000 employees serving 60 million beneficiaries. By 2024, it was about 57,000 employees serving 75 million beneficiaries. Fewer workers, far more people. That is why hold times are real. Call early in the morning, midweek if you can. The Social Security website also lets you schedule appointments online without a phone call, which can save a lot of frustration. The friction is real, and the call is still worth making. If you are a retiree or someone caring for one, you now have the framework, the form numbers, the phone number, and the website. The system is not going to audit your benefits for you. It never has. But you have everything you need right now to do it yourself. This is general education, not personalized advice. Before you act on any of this, please talk to a financial advisor, a CPA, or a Medicare specialist who knows your full situation, because the right answer for you depends on details a single video cannot see. If this video changed how you think about your benefits, that little like button is how I know which videos to make next. And one more thing before you go. We just talked about how IRMAA is calculated from your income 2 years before you receive your Medicare bill. Here's what that means in practice. The income decisions you make at age 63 quietly determine the Medicare premium you pay at 65. And the difference between two retirees with the same lifestyle can be hundreds of dollars a month for the rest of their lives. The next video on your screen breaks down exactly why age 63 is the pivot point. Most retirees find out about too late. Click it now while this is fresh.